Yeah, I mean, right now I've kind of been kicking around the idea of like, if I want to find a market and zero in on a market, that would be good for like short-term rental. And the reason I'm saying that is not just the concept of the short-term rental, but someplace where maybe I can go and Angie and I can live a couple months out of the year, or that kind of stuff. And let me just give you some background. I was in North Carolina a couple weeks ago. It was my dad's 90th birthday. So we went and saw him, and they have a minor league baseball team in town. So, he was feeling up for it. So I was like, well, let's go to the game. So I got tickets. We went to the game and, just kind of getting into the whole minor league baseball thing and going out there. And they're having the 75th anniversary of the stadium there. And I used to play high school baseball in that stadium. So, it was just kind of like old times. Anyway, fast forward, and I'm like, there's some markets that have some minor league baseball teams that would be, good short-term rental, seasonal resident, work remote kind of thing. When I was kicking around Asheville, North Carolina, Charleston, South Carolina, Chattanooga, Tennessee, I wanted to be in a, we'll say, investor-friendly state, right? Not only from short-term rental regulations, but just, taxes and stuff like that. And, just kind of, and then, as we mature, Rob, I could be one of those guys that hang out at the stadium and just chat it up with all the people. It's kind of like, instead of being the greeter at Walmart, I could be the greeter at the minor league stadium. So, and you can spend a little bit of time. So I was kicking that around, and I was like, well, there's one in Myrtle Beach, and there's a team in Asheville, and there's a team in Charleston, and I'm like, I'm going to pick 5 or 6 markets and do some, a little bit of digging, and then when we're not there, is it a good place to have a short-term rental? So, or is it someplace, eventually you sell your short-term rental and sell or finance it and have a note on a property that you had for a time. So that's kind of what I've been kind of rolling around in my head over the last 30 days. It just got me thinking when I was visiting my dad, and, it's kind of like, hey, this might be something that, in the next 5 years would be something we should look at.
So do you sense or actually see as well, since we're post-pandemic, pre-pandemic, you and I think we have the same sort of philosophy. You're investing where there are jobs and people have income and stuff, right? And that was typically bigger cities and then the concentric circles outside of the bigger cities,
right,
where people and populations were concentrated. But now that we're post-pandemic and we're in this work from home and hybrid society now, where people can go beyond those initial concentric circles, away from the cities. Now they do go more remote and stuff like that. So did you see that? And do you see that more now, where these secondary MSAs and smaller communities are more productive and more demand, rather, not so much productive, but seeing more demand to maybe drive some of this thoughts in your head too? And do you see it now that real estate has become more and more granular, that location it's not one size fits all anymore, and location does matter in these days?
Yeah, I think so. And I think part of that also is just, as we've evolved in the note business, especially as individual investors and entrepreneurs, it's not as important that you're situated in a city or location where you can recruit, employees and talent, right? Because you can do stuff remote, and, everybody talks about, well, the lifestyle of being in the note business is a perfect fit because you can do it from anywhere, right? And we may go on vacation for 3 weeks. That doesn't mean we're not plugged in to some degree.
Sure.
of still keeping our eye on whether it's our loan portfolio or what we have in the pipeline or managing the assets that we have. We can still do that regardless, as long as you have an internet connection, pretty much, and a
Right.
phone. You can pretty much do that. And, now with all the vendors and virtual assistants you can get, you don't have to build your team in the location you're at. So to answer your question, yeah, I think that the locations are becoming, and this is going to impact the commercial real estate markets, especially in some of these bigger cities where they were used to having the hub of everything being in there.
Right.
But yeah, moving to a secondary or tertiary market is, as far as like, what I want. I mean, who really would say I want to go to Chattanooga, Tennessee 3 years ago or whatever, right? I mean, just kind of like, really, that's kind of like in the mountains between Georgia and North Carolina and Tennessee and what's up there, but it could be the ideal place if you can stay plugged in and live the life you want to, right?
And what I've noticed too in some of these secondary and tertiary places, as I've visited as well, you see a big influx. A perfect example, I have one of my notes in on the outskirts of South Portland, Maine.
Nice.
And we took back the property. I know nothing about South Portland, Maine, but as I talk to people on the ground there, they're talking about how everybody's leaving Boston and New York and coming out into the mountains, and there's so much demand. The property and value prices are, going through the roof. Like, really? And you get into all these places. Yeah, people are leaving, and people are looking for, that lifestyle now where they can't look right behind here, right? Where you can live a nice lifestyle and still do work remotely using and leveraging technology. And so you don't have to be tied to the big cities anymore. So it is an interesting dynamic. It's interesting what's going on. And so, yeah, short-term rentals.
And I think it makes it harder for a lot of companies that do want their workforce to work in-house when you're going about recruiting employees and talents, right? Because if you're like, oh, I'm willing to come into the office, all of a sudden, if they need people in the office, you move right up the list of possible candidates, because some people are like, no, I really like working remote and I don't want to have to go into the office, and that comes into, well, are you a fit or not for whatever that particular company is looking for? And,
Yep.
I've got children in the workforce, and I'm like, you got to be flexible. You don't mind work from home, great, but if you want to go in the office, you got to be flexible to do that too, and your options will be a lot wider as long as you have that flexibility to do that. And some people have issues on why they want to stay or why they want to go into the office, but I think just having that flexibility. But the point is, it makes it an added layer of what do you do when you're trying to recruit employees.
Sure. And I've heard this concept of, from the development side, about 15-minute cities. You ever hear of this? 15-minute cities?
No.
Where they want to build, in these newer cities, a hub and build housing within a 15-minute walk, so that you don't have to have cars, you don't have to have vehicles. Everything you want to live, raise a family, will be all within 15 minutes of walking. And they're building these cities where parks, resources, workforce, all together, all within a community. You don't have to drive to anywhere. Everything is within walking distance. I think that was part of what I heard. One of these stories, I guess, was part of, trying to go green, getting more vehicles off of the road and stuff like that. So, okay, that can work. And, if you're building stuff like that. And then the flip side of the reality comes into play, where I'm getting more and more calls from my consulting business of people and builders who are stuck in these development loans and construction loans and are looking to go to permanent financing. And the permanent financing that's available out in the marketplace right now is somewhat more expensive than their construction loans. And it blows up their budgets, and it blows up their exit strategy, and it stalls projects. And I'm seeing more and more of that happening. So that kind of slows down that idea of getting these 15-minute cities put in place, because it all comes back to our business, the debt side of the business. If you don't have the debt and structured properly and set up properly, A lot of those dreams and forward looking plans, get stalled because you got to have the money in place properly. But I'm seeing more and more of that where um, people are having trouble getting out of their multifamily and their development projects because the permanent financing is just not where it used to be, because interest rates have gone up and it causes a problem. Um,
Yeah, I mean,
what's the
well,
answer there? Some
you have the two factors that are impacting that, right? You had a lot of syndication deals, whether it was an office, an apartment, or retail project. That your basic strategy was, I'm going to exit this out in 3 to 5 years by refinancing,
Yep.
right? And that's also contingent on the income that property is producing based on the tenants. And those tenants are now, especially in the office environment, there's vacancy rates. So
Yep.
the income you were projecting is not where you thought it would be. And the interest rate on your debt service is not where you thought it was going to be when you exit through refinancing. And there are going to be some distress situations there. And, to your earlier point about projects being stalled, we both live in what I consider two of the most attractive markets, the Dallas-Fort Worth area and the Charlotte, North Carolina area. But my wife and I were driving back from church the other day, and we're driving down the road. And it's like, well, they ain't done anything on that house in like several months, and it looks like it's about 75% complete. And I was like, they either ran out of money or their cost of funds went up. And it used to be a couple of years ago they were having material. Well, they can't get lumber, or they couldn't get something, so they're waiting for the supplies to come in because of the supply chain issue. Now I think it's a financing mechanism. Either the builder had issues with his construction loan, or the homeowner had issues with their loan or their permanent financing piece. And you got a 75% built house, and I'm talking like this is like between $1 million and $2 million property. This isn't the starter home thing. So that debt service is just building up on one of the two parties.
Yeah, and that goes back to the core of what we do, right? We're in the business of deleveraging. That's all we are, right? I mean, sure, we buy loans, but we're buying them at discounted prices. We're buying them on sale. That's part of the deleveraging process. Is you're lowering your basis, restructuring a loan, and you're taking people's debt burdens and restructuring their debt burden so that they can deleverage themselves because they've over leveraged. That's part of the natural process. People
Right.
over leverage, taking out too much debt, and we help them to restructure it and deleverage. So it's not any different on the business side of the construction side. The over leverage is the over leverage. So I think that creates a tremendous amount of opportunity in this industry where you have these builders, and as you said, because I have the same thing here, where behind me they're building another 200 or 300 units, and they can't get them up fast enough. And yet, right down the road, you'll see like a multifamily project that's kind of stalled as well. I'm being told that everything on the MLS here in the Charlotte area has got 2 and 3 backup offers, and
Really?
everything is being bid up. So there's this huge demand here. They can't get stuff built fast enough, but yet there are still some developers that can't get things moving. And I agree with you. It's probably because of the debt structure.
Yep.
I just got a call again from a construction manager that I recently hooked up with, who says his clients, all of the investors who are his clients, he's got a bunch of his investors that can't continue to pay him and move the projects forward because they're having issues on the debt side. So he wants to bring me in to see if I can help him to restructure. Of course I can, at a fee. We can do anything. But it's not any different from what we do. What's the difference if, we're buying that, restructuring it? It's all a deleveraging process.
Right.
But again, even there, I think that creates tremendous amount of opportunity, even converting some of this debt to equity, especially in markets that have demands, that if you can just stretch this out a little longer, and push some of the payments and some of the debt service into equity, yeah, you'll get these things leased up. You'll get income off of this, and you'll get paid, and you can it's the opportunity to take a bigger piece and make more of a return in these situations. But I think you're going to see a lot of that, especially on the commercial side. And I see a couple of players out there now that are just the lender side, bigger lenders that are just lending on repurposing some of these commercial spaces that have been vacant.
Yeah, you're gonna see people that are sitting on capital, some of the large institutions or even some of the private individuals, that are sitting on capital and trying to figure out, okay, how can I best maximize, getting this money out on the street, right? Can I help somebody deleverage? And if so, what is that going to look like? And there are opportunities. I mean, we have people all the time. It's like, I've got this money. How can you help me deploy it? What kind of, can I get into a reperforming loan portfolio? Are there non-performing distressed assets that, I can participate in? Or the hard real estate? How can I get this? And, how can I put this to work? We have a lot of people reaching out to us, wanting to buy land.
Yeah.
And whether they're, even if it's just a hold right now, I have an opportunity to buy, 50 acres of land. I may bust it up and subdivide it one day, but right now it's too good a deal, and I want to go ahead and, lock it up. And, that's of interest to certain people that are sitting on money that are like, I'd rather have it in real estate.
Yeah. Because if they got the patience, this is just like I said, this is just a cycle. We're just getting into the downside of a cycle. That's where all the opportunities come. If you've got patience to get through the cycle, when you come back on the other side of this, it's almost like, people call it dollar cost averaging, right? Stock market goes down and a lot of people get fearful, and then those traditional financial advice, well, just buy more. You're dollar averaging down, so your cost basis is lower. Why is this any different?
Yeah.
Right?
Yeah.
Why is it? Well, I got to wait for it to come back up. Yeah, it's okay. I love one of the guys that I follow. He loves to put. It's so simple the way he puts things. He goes, it's the same thing. I love tuna fish. My wife goes to the store and she buys tuna fish and it's on sale. Why wouldn't she buy more? She buys more when it's on sale. What's the difference in real estate? It's just going on sale. Why wouldn't you buy more?
There you go. You
want to run away from it. It's the same as tuna fish. I'm like, I've never heard anybody relate that to tuna fish, but he's right. If she's got a coupon,
I've
she
never
go buy
really connected real estate and tuna fish as an analogy, but I'll keep that in my back pocket. I liked your comment about patient capital, because we've talked in the past about passive versus active investors. Okay, but when you're talking about capital, there is a difference between active capital and patient
Absolutely
capital, right? Some people, realize that if the opportunity, like the tuna fish, is on sale and you're patient and you go ahead and buy it now and you can wait it out, that property is going to be right where you want it. Where there's others that have certain pressure on them to deploy the capital at a certain return, and they're not patient. They want to get it out there and they want to get it back and they want to get a certain number, and that tends to be a little more expensive than some of the patient capital.
Yeah.
The patient capital can take their time, and we say the life's too short bucket. I'd rather deal with an investor that has patient capital than somebody who's, hey, where's my money? Where's my return? I got to have it because, I don't need the hassle.
So that reminds me of our mutual friend and colleague, Jeff Watson, who I heard him use the term once of a wantrepreneur. Not even an entrepreneur, but the wantrepreneur. The people that keep chasing and chasing and chasing and get in and out of deals and in and out of deals, because that's not an investor. You're an investor when your money goes to work and you continue to build your wealth when you're not there doing anything. If you actively have to be in and out and in and out, in and out, and your wealth and your money making is dependent upon what you do on a daily basis, you're not an investor. You're a wantrepreneur. You want to be an investor, but you're not there. Okay, and that when we talk about the active capital versus the patient capital, that's exactly. It reminds me of Jeff's term of wantrepreneur is not a real investor. They say they're investors, but they're not real investors. They're fooling themselves. But it's that patient capital. And look at what's going on in the world today, right? With all these banks that are failing, and who's the patient capital? All the big banks. that are scooping up all these other banks because they're sitting around and they've got the money there, being patient, and they know there's more failures that are going to come, and they're going to be right there to pick these things up on the ready and pick them up for fire sale prices. Again, let's go back to the supermarket. Any supermarkets that go out of business and there's a liquidation sale and you're getting everything for 40, 60, 80% off, come for the bankruptcy sale and we're going to liquidate everything and come get everything, at pennies on the dollar. And it's the same thing that's going on in the banking industry today. And then you got the big banks that are there with the cash on the ready, being patient, and that's how they become bigger. By being patient and being ready.
That's it, for sure. Although I do see some of those retail businesses with the going out of business sign that's been up for like 3 years. I think it's just their marketing strategy.
I remember a story of a marketing strategy. It's similar to that, where it was like guerrilla marketing or something like that. I was at a conference. They were talking about this guerrilla marketing and how simple marketing can be. It doesn't have to be overly elaborate. And there was this one little general store that was parked right in the middle of a big, giant box store and a big, giant box store. And on one side of the box store, it said, "We've got the best prices." And the other box store says, "And we've got the best service and the best convenience." And the guy in the middle, he just put a sign on top that said, "Enter here." That's all he did.
There you go. I like it.
So you just gotta be creative. Yeah. So if it's a liquidation sale for 3 years that gets people to come in, sure.
There you go.
It doesn't have to be overly complicated. All that guy did was put the sign up that says, "Enter here." Okay.
Well, let's pick up on that word liquidate, because we have a lot of folks right now. I know I'm seeing across my trade desk that are looking to liquidate parts of their portfolio. And I think it goes back to some of the deleveraging you mentioned earlier. They have, debt service they're worried about. But I think there's also just the whole fear factor of, should I get into cash and, do I need to liquidate, whether it's, we'll call it a subperforming. It may not be a distressed asset, but it's, it's subperforming, and in their mind, it's leaning towards going in a direction where they can't passively manage it. They're going to have to get more involved, and they really don't want to. And I think we're seeing opportunities in that space where people, whether it's a hard asset like, a certain property they have, or it's not performing the way they thought it would, they want to just go ahead and cut bait and get out. Or if it's in a note portfolio, they're looking to, either close their fund down, get the money back to their investors and go ahead and liquidate now. Or whether it's a portion of that and just go ahead and get rid of the part that's, like I said, subperforming. So I'm seeing a lot of that come across my desk, and there's a lot of good opportunities. What are you seeing in that kind of
same? And it's interesting that you say that, because I constantly talk with my team about whether we should be liquidating some of our portfolio, not because of so much of the assets, because I look at this as a good time to gentrify some of my investor stack. And get rid of some of the people that have outlived their welcome. We'll say it that way. So it's a good time to do some cleansing and gentrify some of the investors. I don't know if that's taboo. You're not supposed to say that, but I'll say it anyway. I have right fit clients and got to serve the right people. And if they end up not becoming the right people, maybe they shouldn't have come in the first place.
The market has changed too, right? So they may have been a good fit for you
back then, right
at that point in time. But based on what's going on right now, you're not a good fit. So I'm going to return your capital and wish you luck and go on. And you got some new guys to take their place.
Yes, exactly.
No hard feelings, but we're just not a fit anymore. Right. You helped me out 3 years ago, and it was a fit. But right now, we're chasing this new business channel, and I just don't think it's for you. And good luck.
So that's it. So going back to the liquidation, we think about and talk about some of that too. Is a time to liquidate, not again so much for that for the debt service and stuff, but to cleanse some of our investor base to allow for more efficient capital to come in, and but we see some of that as well.
I would advise everybody watching, hey, you need to periodically analyze your capital stack and figure out, almost on an investor by investor level. Who's a good fit? Who's not? What do we have to do to move this? Who do I have in the wings that I'm bringing on board? And part of your, whether it's annual or quarterly, evaluation of your portfolio and investments should be review your capital stack. Because, Rob, we know there's a lot of opportunity. I'm always looking to have money on the sidelines. So when I have one, I can call folks up and say, okay, I'm ready for that next tranche of money to come because we have this to put it into. And you got to keep those people, engaged and active and warm, so to speak, so that when you have the opportunity, they're ready to, wire the money in and you're ready to fund. So keeping that, I try to do it on a quarterly basis, but to be honest with you, it ends up being more like twice a year. I really need to get back to where I can do it on a more regular basis and just, make sure.
So everybody listening to this, take this as a public service announcement. We do think of you that way, that if it becomes too much of a problem, we will look to get more efficient capital. Yes, we do think like that. In case you didn't know that, you should know that.
Yeah, exactly.
But going back to the liquidation, I'm seeing some of that too. Look, and then like you said, it creates opportunity to pick up some of this stuff because, again, let's go back to the banking crisis and what's going on with there. That hasn't technically started yet, but it's going to continue. Just because some of these banks go on doesn't mean necessarily they have bad assets, right? They could have bad management. They could have a poor balance sheet and be over leveraged, and they could be taking on too much risk that causes their demise. There's so many moving parts that could have allowed it to fall, but it doesn't necessarily mean that the entire balance sheet is impaired. There's probably some good assets, most likely some good assets somewhere on those balance sheets. And that's what a lot of these other banks and other players coming in are picking up, or a lot of this good stuff. So it's similar to what goes on in our industry too. We have some of these other players that want to liquidate. Doesn't necessarily mean they're bad assets. It could just be, as we said, maybe they've got a mismatch between their capital and their organization. It could be any number of things, but it doesn't necessarily mean that the assets are. It also doesn't mean that you don't do your due diligence on it, or you skimp on your due diligence. Just still do it. But it does. It creates opportunity within the industry and around in other ancillary industries as well. I think these are one of the best times to deploy capital, in my opinion.
I agree 100%. I mean, I would say in the last 60 to 90 days, I've been as busy as I've been in a long time as far as seeing. Now, I say discipline. Not everything that comes across the trade desk is a deal for us. It's just not a fit. But you're not going to know that unless you see a lot of flow coming through to you. And you're able to analyze which is a good fit and which isn't. And we're at a point now where we're seeing stuff that, we're taking a pretty good swing at, that we would like to have it. And some is just a risk tolerance. We're good and comfortable with it in today's market. And some folks are like, you know what? Nothing really wrong with it, but I just want to get out of it right now.
Yeah, look, and you said a couple of things, and we're gonna wind down in another minute or so, but a couple of things that we probably want to touch on moving forward in some of these other conversations that we're having is discipline and having a, quote, buy box. I have a specific formula that I use. I think everybody for their own business should have a specific discipline and a formula so that it's your barometer and measuring stick, so that as you get deals across your table, and honestly, I personally believe it should be for the asset side and your investor side, that you got to qualify deals that come into your business, and you got to qualify the investors and the money that come into your business in order to truly be successful. And I think that's lacking in this industry. That, well, what is the buy box? I just want to buy everything. I'm just getting at a discount. And just because you're getting something at a discount doesn't necessarily mean that you're actually going to make money on it. Right? I've been teaching a course now too on this. And yesterday we just talked about enforceability. What's the difference if you get the piece of paper in your hand? If it's not enforceable, you just bought something that can just be, wallpaper. Just put it up on your wall because that's the only purpose it's going to serve. You can't go and enforce it. And we talked about, underlying liability with it. And if it's not enforceable, what's the difference if you got it at 10 cents on the dollar? Great. You're the bigger fool here.
Yeah. It sounds good when you're at the country club and you tell somebody you bought something at 10 cents on the dollar.
Yes.
Right? You don't go back and tell them that it was a worthless 10 cents on the dollar.
So and we should have an episode on this too. We're going to go look at. We should have talk about our worst strikeouts, because I got a bunch of those, right? And those are my best throws, are the ones that I messed up on, but I got good value out of it. I still got a couple of those going on now. No one wants to hear about your wins. People want to hear about your losses.
Well, I'm glad you're coming and building a buy box and getting rid of the dartboard you always relied on over the years.
Yeah, so we should definitely talk about that and put a dartboard on there. Yes, is that one good? Absolutely. But I think we should definitely talk about some of that in coming episodes. So let's say we do that. Agreed? We'll do that?
Yep, sounds good. I'm sure we're making notes, and we'll come back and say, all right, let's pick up where we left off next time.
All right. And I will see you next time, my friend. Talk to you later.
All right, man. See ya.